This week's number, $9 million. That's the record sum of college scholarships a New Orleans high school student received from 125 institutions. The student, who applied to more than 200 schools, has a 4.98 GPA, is fluent in Spanish, holds leadership positions in the National Honor Society, and 2 years into high school started earning college credits at a nearby university. True story. The hottest girl from my high school came into my work today, and I don't like to brag, but we made out. That's the good news. The bad news? I work at the morgue. Welcome to Prof G Markets. That's right. That's why you come here. Today, we're discussing cable television, Johnson & Johnson's IPO Roadshow, and earnings from Google and Meta. I am cracking myself up. Here with the news is Prof G media analyst Ed Elson. Ed, we experimented with AI today, and I thought it did an excellent job of AIing you or sounding like you.
I thought it did a terrible job. I sounded Australian. I thought it did a terrible job. I sounded Australian. I guess that's what everyone says about me.
Yeah, no, yeah. I think you sounded.
How did you find your voice?
I actually thought it was pretty good, although the AI rendering of me just looks so fucking old and ugly. Oh, wait, it wasn't a rendering. Anyways, so just for the fans out there, we're trying to figure out how AI might leverage our IP, and we might do some translating to different languages with the pods, et cetera. And we're trying to figure this whole generative AI thing out and came to the conclusion that, while it has a lot of potential for us right now, we haven't figured out how to deploy it. What was your general thoughts and reactions, Ed?
I think the best thing that we saw was a video editing clip AI, which basically you just feed in our content, and then it finds short little clips that you can post to TikTok and Instagram Reels, which we'll be talking about in a moment. But I thought that was probably the best implementation. The rest of it feels a little bit gimmicky, I'd say, at the moment. You know, does anyone really want to listen to Scott Galloway AI just reading the news? I feel like you need something sort of substantive. But when it comes to sort of menial tasks, that's where it works. I thought Patrick, our video editor, made a good point, which is that I think people come to us for analysis, not just to hear the news. I mean, you can go to any news site for that. And unfortunately, I don't think AI is at a point yet where it can provide substantive analysis. And if it does, it's unlikely you're really going to trust it because it just gets so much wrong.
Yeah, it does. It definitely feels like it's totally void of, whenever I've been experimenting with it a lot, it comes back totally void of any creativity or insight. As a matter of fact, I don't know if you saw, but on Wednesdays, Ed and Jason, our editor-in-chief, send me a draft of No Mercy, No Malice. Send me a draft of our newsletter, or at least the key components of it, and I start editing and writing other parts of it. And the biggest insult I could come up with, because I thought it was especially weak this week, was this feels like AI wrote it.
Yeah, it said, vanilla / boring / nothing. This sounds like it was written by an AI.
Yeah, and what's interesting is I think the name generative AI is a bit of a misnomer. I think if it were more honest, you'd call it productivity AI, because if you try and generate something original with AI, I don't think it does a job, but if you give it good content, it can, as you referenced with this video, it can chop it up and disperse it and really elegantly zero in on good stuff. Anyways, enough of that. Enough of sharing our industry secrets here. Break down the news.
Let's start with our weekly review of market vitals. The S&P 500 fell through most of the week before rallying on Thursday. The dollar also fell. Bitcoin rallied midweek but remained below 30,000, and the yield on 10-year treasuries fell the most since March. Shifting to the headlines. After teetering on the brink of bankruptcy all year, Bed Bath & Beyond finally filed for Chapter 11 and said it will close all of its stores. LVMH became the first European company to reach a $500 billion market capitalization, and that's thanks to strong sales in China, as well as a strengthening euro. US GDP rose at a slower than expected rate of 1.1% for the first quarter. Disney is suing Florida Governor Ron DeSantis for voiding a deal that gives the company control over the design and construction of its theme park properties. Disney is alleging that DeSantis is waging a, quote, targeted campaign of government retaliation for opposing his law that restricts discussions of sexual orientation and gender identity in schools. Dual-class shareholder companies are now eligible again for inclusion in the S&P Dow Jones indices. Multi-class shareholder companies were banned from those indices in 2017 in response to Snap's IPO, when only non-voting shares were offered to the public. That was a move lobbyists said eroded corporate governance. First Republic earnings showed the bank lost more than $100 billion in deposits last quarter. The company said it's exploring a sale of up to $100 billion in assets to support its balance sheet, and shares hit a record low after the report, down around 95% year to date. And finally, Microsoft beat on earnings with cloud revenue up 16%. Shares popped 7% after the report. A day later, though, the UK antitrust regulator blocked Microsoft's $69 billion acquisition of gaming company Activision Blizzard. That should make it easier for US regulators to do the same. Shares of Activision fell 11% on the news, though Microsoft continued to gain on its strong earnings. Scott, a lot there. Where do you want to start?
Well, let's go in reverse order. So it's interesting that the market doesn't mind that Microsoft's acquisition of Activision is slowly falling apart. And that is because Aswath Damodaran points this out, the professor of finance at NYU Stern, that 2/3 of acquisitions don't work. 2/3 of acquisitions end up destroying shareholder value. The temptation to spend a bunch of money and overnight just add water, have a big new business and have it be accretive is so intoxicating that the majority of CEOs talk themselves into acquisitions that usually they overpay for, or the synergies they describe are not, never materialize. And they also have a bias towards doing bad acquisitions because, well, over the long haul, it might take the stock price down. CEOs are compensated based on, a compensation consultant comes to the board and says, based on the size of the company and the type of the company, this is the range of compensation. So the bigger your top line revenue as a company, the bigger your company, the more or the greater your compensation or expectation or recommended compensation. I thought that was interesting, but Microsoft, you could argue, I think, has probably been, maybe with the exception of Apple, the best managed company over the last decades. And even though they miss search, they miss social, they miss mobile, they continue to be one of the 3 most valuable companies in the world. And also the cloud revenue, people love that. Obviously, the future belongs to the cloud. So, they continue to impress. First Republic, its stock is up a little bit today, but there's just no doubt about it. The banking sector, it does feel like this is ring-fenced a little bit, that this is sort of the last vestige of the bad news. At least it feels that way. Supposedly the next wave of bad news is banks that have a lot of commercial real estate loans, but analysts are trying to parse through which commercial real estate is the toxic kind, the office space versus, malls and things like that. Or, there's all kinds of different commercial real estate, whether it's a car wash or what have you. So we'll see what happens there. But it does feel as if the banking crisis has seemed to subside a bit. The Disney versus Ron DeSantis, Governor DeSantis thing is, I think, really interesting. I think the governor who has demonstrated real discipline around political messaging and has tapped into this reservoir of anti-woke sentiment among people saying that political correctness had just gotten out of control, and his success and confidence coming off of what was, I would argue, a successful approach to COVID, where he tried to keep the schools open, sequestered the seniors. Most people would argue that the governor got COVID right as it relates to Florida. This is a bridge too far. This will go down in history, in my opinion, as the beginning of the end of his presidential run, because effectively the GOP has always said we are business friendly, that if a business is allowed to thrive and succeed and the private sector is given, field to run, that it can generate top line revenues and taxes that pay for your, you Democrats' social programs and our Navy, and it's just the private sector is where true capitalism lies. So they err on the side of being pro-business. And this just feels anti-business. He's going after the largest private employer, kind of one of the premier companies in the world, much less Florida. It also feels vindictive. you're supposed to, when you're elected to office, let bygones be bygones and pass laws that are good for the Commonwealth, but not engage in retribution and take out your political animosity or use the power of the office to attack your political adversaries. And this is what this feels like. It just feels as if, okay, I don't like Disney. They didn't support one of my narratives, political narratives, so I'm going to go after them. And he fucked with the wrong cowboy, specifically in the mouse. And that is, Bob Iger is much more disciplined. I think Disney will be in Florida a lot longer than Governor DeSantis. And Nikki Haley, who's also a candidate for president or for the GOP nomination, kind of summarized it and said that we welcome Disney to South Carolina, and while we are not woke, we are not sanctimonious. And I think this was a terrible movement. Let's move on to LVMH. So, first European company to reach 500 billion. The ultimate strategy in marketing, we should just call marketing scarcity. And that is, there are two ways to build stakeholder value. One is to push down your costs such that there's greater margin between your costs and the prices you charge. That's a business of scale. That's Sam's Club, that's Dell, that's Walmart. And that is a business around operational efficiency and scale. And typically there's only one or two companies that can pull that off in any sector, see above scale. The better way to make or to create stakeholder value, in my view, is to push up the line called perceived value. And that is, give people the sense that they're more like Mike, or that, oh, I love those frogs, I'm going to buy a Budweiser beer, or I like the feel, I like the way I look in a Jaguar. I think I'm more likely to have a random sexual encounter when I buy a Range Rover than if I bought a Hyundai. All of these things create increased perceived value or self-expressive benefit. The master of self-expressive benefit and perceived value is LVMH. They take a $300 worth of leather and artisanship and turn it into a $5,000 bag. And one of the ways they accomplish that is they purposely constrict supply and they create artificial scarcity. And the master of this is Hermes and Chanel, but LVMH does a great job as well. And that is their products, Louis Vuitton, they could produce a lot more of those bags, but they purposely create artificial scarcity such that you create that want and that desire. And it goes to a very primal instinct, and that is the things that are in short supply we become obsessed with. We become obsessed with mating opportunities because 90% of men and a lot of women have an absence of mating opportunities, and that's key to propagation, key to the continuance of the species. So we become obsessed with finding a mate. We become obsessed with finding sugar, fat, salty foods. Why? Because for the majority of our existence on this planet, those things were in short supply. And when you create artisanship and give people the impression that, no, you can't have that Birkin bag, you have to order, there's just too few of those $12,000 bags for you to actually go into a store and buy one, we become obsessed with them. And so to create the illusion of scarcity it's such an incredible skill that you can create a monstrously profitable company. And there's a lesson here. And that is the sexiest word in the English language is no. And the way I would apply that to our business is, and we try to be transparent here at Prof G, one of the ways we monetize all the work we do is through speaking engagements, mostly where the national cotton growers, or I was at Adobe last week. I don't forget where I'm going next week. I'm going to be at Expedia. Anyways, I'm probably not supposed to say that. But what I do is, the reason why I get such batshit crazy fees is because I say no to 90% of them. And I position myself as a luxury brand. And I have two prices, either zero or out of control batshit crazy price. Zero is for the nonprofits or people I know. And the out of control crazy price is meant to effectively say no to 95% of the people who inquire about our speaking. And it creates this illusion of scarcity and drives up the margin and perceived value of an angry professor with ED spitting expectorates and platitudes at a group of people there to, in between the speaker talking about, how they climbed Mount Everest and found God or some bullshit. Anyways, scarcity is really something you want to understand, because if you can create scarcity in your personal life, your professional life, you always want to leave a party a little bit early. You don't ever want to be the person that sticks around too long. You want to create a certain level of scarcity for yourself around your professional and personal brand. And I know that sounds a little bit obnoxious, But you want to be the person that leaves a little bit early on a lot of different levels. Anyway, I don't know where I was going with this, Ed. Anyways, LVMH is doing really outstanding. U.S. GDP continues to grow. I continue to believe if we come out of COVID, relatively speaking, stronger than any nation in the world. Our inflation is down to 5%. Our economy is growing. We have huge problems, but relatively speaking, we're doing better, I would argue, than any nation in the world. A lot of news. But most importantly, one person is, when you're talking about Ron DeSantis and Bob Iger, one person would be a fantastic president. The other is Governor DeSantis. That was good. No AI, no generative AI. Prof G is going to come up with
genius.
Insight like that.
Yeah. Let's move on to our next story. Last week marked a historic moment for cable news. Don Lemon was fired from CNN. A few hours before that, Fox News announced Tucker Carlson was out. That came just a week after Fox News agreed to pay a $787 million defamation settlement to Dominion Voting Systems after it falsely accused the company of rigging the presidential election. Meanwhile, NBC Universal fired their CEO, Jeff Shell, after a harassment complaint, and ABC News fired Nate Silver, the founder of 538. Scott, that's just a lot of stuff going on in cable. What is your macro take here?
Well, on the cable side, I think it's really interesting, and that is everyone zeroes in on why Don Lemon and Tucker Carlson were fired. And I think it sort of indicates a couple things. One, I wonder if media is saying maybe we shouldn't be as polarized. Maybe there is some opportunity in the abandoned middle. I wonder if it's an accident that the most partisan of these partisan networks was fired the same day. And that is, Don Lemon is very partisan and Tucker Carlson defines the term partisan. And it just so happens that the most extreme anchor on both networks was fired within 48 hours. Now, there wasn't any coordination here. That the firms and their executives hate each other. But also, this is really about structural decline in the ad-supported market. While Fox grew, it didn't grow a lot, and CNN is actually in decline. And bad behavior or something they don't agree with, you get fired for it. And good times, they overlook it. So when things are not good, people are looking for reasons to fire you, especially when you're probably making a shit ton of money. And also, the real lesson here is that people will always inflate the ratio of their importance to the platforms. Shelley Long decided she was too big for Cheers, as did McLean Stevens for MASH. They decided they were going to be big movie stars, right? Money Pit, True Beverly Hills, right? That's what Shelley Long went on to accomplish in her career. And this happens every day in the corporate world, and that is someone is killing it at Goldman or at McKinsey or KKR, and they think, wow, I'm going to bust out and I'm going to be huge. And what they realize is they underestimate how powerful the platform was. Now, query me this. What former anchor at Fox has gone on to do anything? Is it Glenn Beck? Is it Megyn Kelly? Is it Bill O'Reilly? I mean, who is it? Who's got it? Lou Dobbs? Anyone hear from Lou? So these platforms are incredibly powerful. And the Murdochs, Rupert and Laughlin, know this. And they just decided we're sick of this guy's shit, I think. And we don't need to put up with it. The other learning here is that just in the spirit of transparency or not, I don't know, to talk about shit other people don't talk about, Jeff Shell's firing. I think that the workplace is a great place, and people don't talk about this, to potentially meet romantic partners. You shouldn't use it as a dating service, but a third of relationships begin at work. And if you're young and there's an opportunity to spend a lot of time with someone, to ask them to coffee, at L2, we had a lot of marriages. And at Profit, we had a lot of marriages. And I think it's wonderful. And 99% of relationships that begin in any context or don't begin are consensual, or the person has figured out a way to politely and elegantly express a lack of interest. And if you don't know the difference between bothering somebody and expressing interest, whether it's asking them out for coffee, then you've got bigger problems. Having said that, you need to be careful. And that is, if you are senior to the person, it's probably not a good idea, because there's a power dynamic where you might misinterpret their signals and then find yourself in a situation where you are abusing your power. There's also outright crime that has been highlighted in the media, and those people deserve to go to jail. In addition, once you get above a certain level, your fly is up and locked, boss. You take that shit off campus. There is no dating at your company because you have so much power. It's awesome to be a senior executive at a company. People laugh at your jokes. They think you're more interesting than you are. You make a shit ton of money. You make a ridiculous amount of money compared to everybody else. But here's the bad news. You don't get to have sex with anybody, no matter how interesting you think they think you are, because the power dynamic becomes out of whack. Mm-hmm. And the majority of companies get this right. They say, all right, when junior level employees find each other, and if you're going to ask people to work 60 or 80 hours a week at a place, where else are they going to meet people? If it's a consensual relationship, they need to disclose it, and that's fine. More power to you. People should meet, fall in love, and have kids. Once you get above a certain level, that's it. It goes off campus. There is no excuse for it. And this guy was the CEO. There is no excuse. This was easy for the board. You didn't disclose this relationship. You're the CEO. Mm-hmm. You're all wet. And also be very careful. Tread very softly. And also, if you are senior to that person, be clear. Any misinterpreted signals, you're in the wrong. And you're subjecting yourself to real professional liability.
Yeah. And the same thing happened with Jeff Zucker at CNN too. But I just want to go back to Fox. And you were talking about what is Tucker going to do next? Fox sort of has the power in this situation. Here's an interesting thing that happened to Fox Corporation stock. So when the Dominion lawsuit was announced, or when the settlement was announced, the stock barely moved. After Tucker left, Fox lost around $700 million in market value. It's since stabilized, but it's down around 4% since that announcement. So in other words, the market believes that Tucker is worth around $700 million to this company. My question to you is he that valuable? Is there maybe an opportunity to buy here? Because what you're suggesting is actually Fox is valuable on its own and Tucker's just some guy and he's going to disappear into nothingness. How bad is this for Fox Corporation as a company?
Well, what's interesting is how the market perceives bad news. And that is they see some bad news is different than other bad news. And that is a settlement of $800 million. They don't mind as much because while it's a lot of money, it's the known. All right, we have the cash. We have 3 or 4 billion. So 20% of our cash out the door, and then it's done. We're over. We've absorbed it. The market knows what happened there. We're back in action. Losing your premier host, the 8 p.m. hour, creates insecurity. The market doesn't know if they're going to be able to replicate this sort of I'm a racist but 8 p.m. hour with Tucker Carlson. And that was good. That was good. You're going to get that in a few minutes, Ed.
I got it.
No, you're going to get that. That's good. Anyways, but the market has a more difficult time processing that. There's more unknown. The market hates unknowns. And so it would rather pay out $800 million and have it be done, and we're back in business, than not know whether or not Fox is going to be able to bring the same type of success at 8 p.m. Our editor-in-chief, Jason Stavers, pointed out something really interesting, and that is he doesn't think it's going to be as big an economic drain as some people might think because Tucker was so controversial, i.e. disliked by so many corporations and people, that a lot of advertisers would not advertise on his show. So Jason's thesis is that it won't be as big a revenue hit. I'm saying that I think that 8 p.m. time slot on that platform is more important than Tucker. And they're going to be able to build somebody's brand. Maybe they won't be as successful as Tucker, but it's the hour and it's the platform. There was something fantastic on the podcast Daily today talking about politicians. And it basically said it's not about the individual, it's about the terrain and the issue. And that is if abortion or the right to choose is important and it's Arizona and Wisconsin are going to determine the presidential election, that means the Democrat's going to win, regardless of who it is. Mm-hmm. And I think the same thing sort of applies here. It's about the terrain, it's about the 8 p.m. slot, and it's about the platform Fox more than it is about the individuals. So I think they're going to be just fine. And I can bet that everybody is putting on their best dress and saying, hey, wouldn't I look good in that 8 p.m. hour slot?
Mm-hmm. And just a final piece of data here we're talking about Fox's advertisers. In 2021, the biggest advertisers that were not owned by Fox Corporation on Fox News were Balance of Nature, which is a supplement brand I've never heard of, Liberty Mutual, okay, New Day USA, which
Does it keep you regular? Because maybe I should look into that. Seriously, you get to my age, you really look forward to the sit down. I void or defecate about once every 9 days now, Ed. I'm sorry, continue with your data about Fox. Go ahead.
A veteran mortgage lender. And finally, the fourth biggest is My Pillow, which is a pillow company. So that's your advertising quality. Let's move on to our second story. Johnson & Johnson is preparing to spin off its consumer unit in what could be the biggest IPO this year. J&J is looking to raise more than $3.5 billion in the public markets at an almost $40 billion valuation. The new company will be called Kenvue and will offer well-known brands such as Tylenol, Band-Aids, and Johnson's baby powder. Those products accounted for 16% of J&J's sales last year. The Kenvue Roadshow kicked off last week. So, Scott, we've talked about spin-offs before. As you've explained, the thinking behind a spin is that the assets being spun would get a higher multiple as a standalone company versus being bundled together and priced with the rest of the larger corporation. But I want to talk about what it means to go on a roadshow. There's no official listing date yet, but Kenvue has set a target price. They found their underwriters in Goldman Sachs and JP Morgan. Take us through what things look like from here until the official IPO.
So I've only been involved in one roadshow, and that was when a company I founded called Red Envelope went public. But I've sat in a lot of presentations. A roadshow is essentially the bankers and senior management put together a deck and a presentation and go meet with institutional investors, try and drum up interest such that the night before the IPO, when it's pricing, they come out with a price, and then the institutional investors call and say, we want 10 million shares. And ideally, you want the offering to be oversubscribed such that there's a small bump and everybody makes money. Now, you don't want it to double, right? When Airbnb went public, it priced at 68. It came out, I think, at $150, which meant that the bankers, Goldman and Morgan Stanley, left a lot of money on the table. And that is Airbnb sold 10 or 20% of its shares for 0.5x of what they could have captured had it been priced to where the market was. You want a little bit of a bump, but not too much of a bump. Even worse is if the stock's first trade, where it's priced, it's priced at $20 and it closes the first day at 15 or 18. I think Coinbase was a broken IPO. It's called a broken IPO. It creates a stench around the company that, the market and the company, or the company and its investors, fooled some initial institutions into buying this thing, and it went down, and it creates sort of a stench around it. So it's not only a fundraising event, it's a branding event, but the roadshow is essentially their storytelling, where they go around the nation. I've actually helped a lot of CEOs on this initial kind of pitch, if you will, on the roadshow. And they're basically trying to say, this is the background of the company. This is the basic concept. This is the total addressable market. These are our barriers of entry. This is why we're so unique. Here are the numbers. Look at how this all adds up to an incredible business. It's high margin, high growth, and they want to get everyone's greed glands going, create the illusion of scarcity where we're not selling that many shares, and hopefully get a really robust book such that they can strong arm the bankers into setting a high offering price. And there's always a kind of a bit of an arm wrestling over, the company wants a higher offering price, the bankers want a lower offering price to ensure they sell out and they make some money. Because they're essentially...
Why does that? Yeah, could you take us through why the bankers would want a lower price? Why does it matter that the shares sell out when they go public?
Well, there's a couple of things. One, for a brief moment, I believe the investment banks actually are underwriting or holding on to the stock, so they can get caught in a bad place if the stock goes way down. They have something called a green shoe, where they actually have the right to sell more shares and make fees on it. If the stock goes up, everyone's happy. They then get a lot of follow-on business in terms of wealth management or asset management. They get about between 4 and 7% of the proceeds, or a discount of 4 to 7% on the stock when they take it public. So there's just fees everywhere and money everywhere if the stock goes up. And so they want to price it below market. But keep in mind, that's what the existing shareholders, the management team, and the private investors, or the folks who invested when it was a private company, that's what they're selling the stock for. They're giving up the stock at the price, at whatever the investment bank price is at. It's the people who buy the stock who recognize the upside, and also the existing shareholders. So it's a bit of a dance. The only learning here is that if I were to, someone asked me at a conference, what skill would you want your kids to have? Do you want them to take Mandarin or computer science? And I said, neither of those. If I wanted to impart one skill on my sons that I think is enduring, it's storytelling. And when the CEO stands up in front of, when Jeff Bezos went on his roadshow, I can tell you that within about 3 minutes, every person in the room wanted to buy stock in Amazon, regardless of what the price was. Because you just listen to this guy and he has such a vision and he's so kind of calm. You just think, this guy's going to make me a lot of money. This guy's going to build an unbelievable company. So the roadshow, the roadshow is really the storytelling to institutional investors. And in this instance, what might be interesting about this IPO is whether or not it will kind of summon the dead from what has been a literally winter, a long winter in the IPO market. The IPO market is effectively shut. This is more of a defensive stock. It's more enduring. It's not tech. People are going to want to own this name. Now, why are they doing it is also sort of interesting. And that is when you have a conglomerate, which is what J&J is right now, and that is they have different types of businesses all wrapped into one stock. And I believe J&J is one of the most valuable companies in the world. The market doesn't like it. It doesn't want to take the time to try and evaluate every business and create a valuation and do a bottoms-up valuation. What it usually does when it gets confused, when different businesses are jammed together, it finds the shittiest business, the lowest growth business, and it assigns that multiple to the entire business. So the disarticulation of assets and businesses that creates a cleaner story across those businesses creates a whole that's greater than the sum of its parts. So this could be one of two things. This new spun unit, Kenvue, might be higher growth, might be in a sector that the markets are more excited about, and as a pure play of the consumer unit might trade at a higher multiple, or the core business, the non-consumer business at J&J, might be getting weighed down by the consumer unit that's not growing as fast. This is what people call the good bank, bad bank. And that is separate assets so there's a cleaner story. And when there's cleaner stories, the good assets will trade at a higher multiple. The bad assets will trade at a lower multiple, but when you mix the two, it all trades at a bad multiple. So the disarticulation of assets, a cleaner story, is accretive to shareholders. So I would imagine this IPO will be successful. And I think the market is really pulling for it because people would like to see a thawing in the IPO markets.
Yep. Thanks, Scott. Let's move on to our next story. Google and Meta both delivered strong earnings reports, beating expectations and reigniting some hope for the digital advertising industry. Google's search ad revenue returned to growth after slipping in the previous quarter. Total revenue came in at $69.8 billion versus $68.9 billion expected. And Meta's revenue, which had declined for 3 straight quarters, is also growing again. It's up 3% year over year. Google and Meta shares rose 5% and, get this, 15% respectively. So, Scott, just a few months ago, the digital ad industry was in extremely rough shape. It's something we wrote about. This seems like a dramatic and unanimous turnaround here. What do you think has changed in digital advertising?
This is really interesting. So, again, you guys pointed out that Google has done some sleight of hand here and done some creative accounting. And essentially part of their earnings call was them saying that their cloud business had become profitable for the first time. And the analysis that you guys had performed basically said that no, they just took a bunch of expenses out of the cloud division and reallocated them elsewhere, such that Sundar could say that their cloud business, which has traditionally been unprofitable, is now profitable. Going from 69, the growth is okay here. It's nothing dramatic. I think Google is looking for a story here because I would imagine there's a pretty big overhang from sort of their, all of a sudden they seem to be behind in AI, but nonetheless.
Yeah. Well, so just to interrupt on that, what I'll say about that is true about the accounting, and they basically just subtracted $1 billion from their depreciation costs, which seems a little ridiculous. But if you're looking just at the top line, which they can't adjust. The top line is back to growth. The growth isn't massive. It's 2%, but it was in decline the previous quarter. So I just want to be careful that there are certainly two sides to this.
So it's up 2%. So the economy is growing, I don't know, with inflation. That's barely beating, that's not even beating inflation, right? And it's probably not matching, and does it match GDP growth? Yeah, slightly beats GDP growth, but effectively this is now a mature company.
Yeah.
And what's more striking is, or more interesting, is Meta's earnings. And effectively Meta has doubled in the last 6 months, but it's not back to where it was 12 months ago. And what you have is a couple of things. One, Meta's stock acceleration is a function of a couple of things. One, they have embraced the business strategy of 2023, and that's layoffs or efficiencies. They've now laid off, I think what are they in the teens now? They've laid off a significant number of their staff, and no one misses them so far. And two, the market now believes that the Zuck is waking up from his big gulp grande vente ayahuasca hallucination of the metaverse, and that all of that will flow to the bottom line. They think that there's probably a more sober Mark Zuckerberg in store for the company. And then finally, I think that all of the tumult or distraction at TikTok is really helping Reels. The thing that was super impressive was just how on fire their short form video Reels is. Yeah. And I find even just, and this is anecdotal evidence, but it was confirmed in the earnings report, I'm watching a lot more Reels just because the interface, they control so much interface because people are on Instagram so much. So I think it's a few things. One, the market thinks maybe that he's waking up from this crazy slumber, or I don't know, coming out of this, coming to from this crazy fever dream of the metaverse, and will begin recognizing some of those cost savings as they reduce their investment in the metaverse. Two, they think that the biggest winner from a hamstrung or a punished TikTok, hands down, will be Meta. And also the stock was clearly just overpunished. At its low, it was trading below what a mature manufacturing company trades at. So it was a great trade about 6 months ago. But even the fact that it's doubled in the last 6 months, it's still not back to where it was, say, 14 months ago.
But I just want to point out, you said for your 2023 predictions that Meta would be the best performing tech stock of the year. Year to date, Meta is up 90%. So, whether or not it's equal to where it was a year ago, your prediction is coming true.
It just got oversold. I just remember looking at it thinking, okay, people are valuing this company as if it's going out of business or if it's a mature business, and it still sits on top of a cash volcano. By the way, just to correct the record, Meta has laid off 24% of its staff since 2022. That's a quarter of the people at Meta have gotten pink slips. That is dramatic. And all of that is going to feed to the bottom line. And another prediction we made, Ed, is that by the end of this year, in the back half of 2023, despite decelerating growth at big tech, you would see record profitability, because my thesis is they're going to be able to cut costs, and no one on the front end, no one who buys advertising, no one who uses these products is going to notice that they've laid off all these people.
And we should talk about advertising specifically. So ad impressions are up 26% year over year. You mentioned Reels. Apparently, Instagram usage is up 24%, and that's all thanks to Reels, according to Meta. We were talking a while back about how the Apple privacy changes have basically killed Meta, and that how TikTok is competing and people aren't spending enough time on Meta. Something has happened in the past few months. One, Reels is working. But the fact that Facebook ads are now working again, I was talking to a friend who runs an e-commerce business, and he was telling me that after the Apple privacy change, the whole thing just got crushed. Customer acquisition costs went up. Nothing was working. And then he said in the past, basically 2 or 3 months, his CAC is way down, and suddenly Facebook ads are working again. Yeah, and apparently this is unanimous across the e-commerce, businesses. No one can theorize what has happened. Facebook said that they're using AI to improve their ads. I don't fully understand what that means, but something has happened here. Facebook has cracked this. Do you have any ideas what might be going on?
It does appear that Meta has figured out a workaround. Its impressions increased 26% and its ad prices declined 17%, which means that from a advertiser standpoint, Meta is now a better deal, right? I'm getting the same number of ad impressions for 17% less, which should grow share. Reels appears to be on fire. And also, I think people are probably less inclined to advertise on TikTok, not knowing what's going to happen to TikTok. I think that insecurity has probably played to Meta's advantage. And also, it appears that Meta has figured out a workaround around some of the privacy restrictions placed by Apple, and have figured out, and they used in the earnings call the term AI a bunch. Now, I don't know how much of it is substantive, but they claim they can use AI to help advertisers be more efficient in their targeting, especially across Reels. There's just no getting around it. The management at Meta, they're mendacious fucks. They're bad for the world, but they are very smart, mendacious fucks. And they're good managers and really good business people. And they have, it appears as if they are lowering costs while increasing revenues, and they are getting Reels working. TikTok might become the new Snap, and that is the R&D lab for Meta for the last 10 years has been Snap. Snap would innovate. Meta would say, okay, we'll take that and then monetize it across a broader customer set. And I would imagine that there's a lot of people poring over everything about TikTok's product and trying to incorporate it into Reels. And it appears it's working, but there's just no doubt about it. This is a really well-run company that it continues to levy damage on the world. Anyways.
And then finally, AI was obviously a significant feature in the earnings call. Reality Labs, less so. Reality Labs, which is their metaverse division, had an operating loss of $4 billion. They brought in $339 million in revenue, which is down 50% from a year ago. Mia has this great stat. Fewer than 24% of online adults in the US said they were excited by the metaverse. Is the metaverse officially dead?
I think so. I mean, they'll try and claim that they're doing new things with it. They'll pivot to games, but the market has clearly perceived that he's woken up. And as far as I can tell, the metaverse is just a bunch of incel panic rooms created online for people who have, it just isn't working. I mean, my favorite stat about Horizons World or whatever it is that MySpace currently gets more traffic than Facebook's version of the metaverse. So, and when you think about that, 300 million on 4 billion in losses. I mean, that's a definitive thud. That's a deafening thud. And what the market perceives is the market says, okay, that's 3.7 or $4 billion that's going to go to the bottom line once they continue to sober up, once they have another, a little bit more coffee and get a little bit more sleep, and they're going to start funneling more of that $4 billion back to the bottom line.
So Meta and Google delivered strong earnings, but this isn't the only fight happening in tech. The newest fight is in AI, specifically AI's threat to Google search. The classic model of how disruptive technologies take down incumbents is the innovator's dilemma, based on a book by Harvard Business School professor Clay Christensen. This week on the Unpack, our editor-in-chief Jason Stavers takes a look at the innovator's dilemma and how it might affect Google.
Thanks, Ed. So business school professors are constantly putting out models and frameworks, and most of them fade pretty quickly. But The Innovator's Dilemma was published in 1997, and it's pretty much a permanent part of our intellectual landscape. Christensen's main insight was that dominant companies don't stumble because they make a mistake or do something wrong. They lose their dominant position because they do everything right. So if you look at Google, Google is the dominant search company. They have 90% market share. But what's happening right now is ChatGPT and Bing Chat, startups like Neeva, are using AI to challenge Google's supremacy. And what everyone's trying to understand is, will the dominant company be taken down? So what Christensen pointed out about market share dominant companies is that they tend to focus on their largest customers, their largest deals, and try to deliver the highest quality product that they can. And that's what you should do when you're a large dominant company. You should focus on your strengths. And it works for quite a long time. And it's not that dominant companies aren't innovative, right? So if you look at Google, we are a long way from the 10 blue links era that Google rose to prominence with in the early 2000s. Right now, when you search on Google, you get maps, you get reviews, you get links directly into stores' websites for the products you're looking for, all kinds of information framed in all kinds of different ways. And a lot of that, incidentally, is driven by artificial intelligence, right? So what Google has done is what smart, big companies do. They've poured a bunch of money into R&D, and they've incrementally improved their core product over the years with what Christensen called sustaining innovations. And that's done very well for them. See 90% market share and one of the most profitable businesses in history.
You mentioned that Google Search is a product of AI being a sustaining innovation. They've used AI to better their Google Search product. Why is this new AI paradigm something else?
So Christensen drew a distinction between sustaining innovations, which take an existing product and make it better, largely for its existing customers, or in this case, users, and a disruptive innovation. And a disruptive innovation comes into the market typically at the bottom of the market. It's something that literally is not as good as the dominant paradigm, but has some reason that some portion of the market finds it attractive. Often it's just cheaper, right? Somebody comes in with a shoddy, low quality version of this product. It's not interesting to the high paying customers of the dominant company, but it's interesting to people who can't afford that product or who have some other needs that this new kind of product delivers. So one of the classic examples is Kodak and digital photography. Kodak literally invented a lot of the technologies that underlie digital photography, but they were in the film business, and the quality of a photograph that you could get using Kodak film was exceptional, right? The quality of a photo that you got with early digital cameras was terrible. And so it wasn't a great product. But for hobbyists and people with some very specific technical needs, there was a lot of value in being able to collect a lot of photographs and being able to store them digitally, that sort of thing. And so very slowly, a small market will percolate around this potentially disruptive innovation. But it's not one that's of any real profit or interest to the dominant company. And AI kind of looks like that, right? Right now, if you ask ChatGPT when the next showing of Avatar Way of Water is, who knows what you're going to get, right? These systems, they make things up, they get things wrong. There's all kinds of challenges with them. But that's okay if you're Bing, because nobody's expectations for Bing are frankly all that high. Or if you're Snapchat and you're just trying to add some more value to your existing product with fun, interesting ideas. And so other companies can experiment. Google, on the other hand, has to work. Right? We come to Google, we expect good links, good answers to our questions. So when they demoed Bard and Bard had all these problems and mistakes, everybody freaked out and was like, "Oh, Google can't do that." ChatGPT makes all those mistakes all the time, but it's more interesting and we're not relying on it as much. So at this point, it starts to look a lot like this is a disruptive technology. And what happens and what makes a shoddy, not as good technology that might be a disruptive innovation into a disruptive innovation is the technology S-curve. And so this is a well sort of proven and observed model about how new technologies develop. It starts out with very little innovation, but a lot of work. And that's the flat part of the S. People keep trying new things. They keep prototyping. They keep investing. And you get little improvements here and there. But the people developing the technologies are learning the whole time. And eventually you hit a point where the quality of the technology and the quality it delivers just skyrockets. And then it settles down again. And that's when you can make a lot of money because your product now is really effective at something. It delivers a lot of value. The challenge is that you have to spend that time on the flat part of the curve, building the technology itself, learning how to use it within an organization, building an organization, a sales team, a marketing team, a support team that can support the technology. And so you're there when you get that radical jump. So these outsider companies who don't have a vested interest in an existing search business, they can mess around with AI for months or years, slowly improving it, figuring out how to deploy it. And eventually, it may take off to become a much more useful way to get information on the internet. By the time that happens, the risk is that Google has not put in the time because they have good business reasons not to do that. And it's too late to catch up. Effectively, that's what Google did to Yahoo. There was a time when Yahoo was the dominant search paradigm on the internet. And Yahoo worked differently. Yahoo was an index. It was a bunch of lists organized in various ways. And Google came along, and a lot of companies, in fact, came along and said, there's a better way to do this. We should send out crawlers. We should have an index that you don't see, and then you search it with terms. They had a different way of doing things. And Google had a slightly better, different way of doing things. But they spent years first literally in a garage, and then as a small startup, iterating and improving and improving. And by the time it became clear that Google's approach was significantly better than Yahoo's approach, it was way too late. Yahoo tried to buy Google, incidentally, for $3 billion. Google turned them down. And that was probably the right call. So that's what happens is these technologies come along. They're just not a good bet for the dominant company. And by the time they become a good bet, it's too late.
So you phrase it as a bet, which sounds like the right idea here, that the dominant company doesn't want to make the bet because their hand is already pretty good. In the most recent Google earnings report, Google separated their AI losses into a different category from their other bets segment, which is what they historically have had them all together, and they have this other bets segment, which has all of these different projects they're working on. So the losses on the AI were $3.3 billion. The losses on other bets were $1.2 billion. Do you think that this is an intentional play in order to signal to shareholders and to investors that we're not going to be caught out by the innovator's dilemma?
Yeah, I think that's probably right. And I think also, this other bets concept is something that Google has going for it, which is they have pretty well built into their character a willingness to roll the dice on things, to invest in ideas that may not work, right? So it's the challenge if you're Kodak or American car companies in the 70s or hard drive companies. Christensen looked a lot at the hard drive companies as they manage shifts in technology, is that what become disruptive innovations just don't look like very good investments up front. And we should point out that you only know an innovation is disruptive once it's disrupted, right? There have been a lot of ideas about how you could better greet somebody on the internet, provide a portal, deliver content that have not panned out. And so it's always in hindsight that we say, aha, this is going to work, right? This might not work at all. Generative AI might never get past the hallucination problem. It might always be less effective than Google's current paradigm. We'll only know when it's too late for someone like Google to change the model. But yeah, I do think that it's really important for Google right now in the shareholder marketplace to say, we are taking this very seriously. This is something that we are putting a lot of money into. And the reality is they've been doing this all along, right? The core technology that underpins these systems, this transformer model, was invented at Google. So they're not behind on the technology, but they do appear to be behind in deploying the technology in this new way.
Yeah. They also acquired DeepMind back in, I think, 2014 or 2015, which was at the time the largest, most advanced artificial intelligence company in the world. It seems that, we don't know what DeepMind is necessarily working on, but we know they're spending a shitload of money on that AI division. Do you think it's unfair that we're sort of, just because they haven't released a new product, we're resigning them to being behind in this AI race?
Yeah. And in fact, I would argue they've released quite a lot of products, right? Again, it's easy. We're a little bit the frog in the boiling water when it comes to Google search, I think. But if you go back and you find on the internet an image of a Google search results from 10 years ago, 15 years ago, right? They're starkly different. They have radically innovated the core product, but they've done so, well, not radically, I should say. They have significantly innovated the core product, but they've done so with sustaining innovations, many of which are, in fact, AI powered.
So, Jason, who wins this race?
Well, I think that we don't know yet, but I think that the winner will be determined less by the quality of their technology and more by the appropriateness of their business model and their implementation. And I think that's often the case in these situations, right? I'm sure Google has within the halls of Google sufficient AI technology to be doing any number of amazing things right now. The challenge is that you have to do that in a way that that makes a product for somebody that somebody's going to pay for. And Google's primary product is advertising space, right? It is bringing users to the internet and getting their attention and then reselling that attention to advertisers. And they can do that because they have the most compelling way to kind of on-ramp you to the internet. You have a question, you have something you're trying to find out, you're looking for interesting content, you go to Google and they take you there. And along the way, they have your attention. So somebody else has to figure out how to do that in a way that's significantly better than Google and do it in a way that makes money. But the key is that if you're Microsoft, you don't have to make very much money with Bing because you can just give away Bing the same way that Google gives away Docs, which is a product that Microsoft charges for, and gives away Android, which is a product that Apple charges for, because it's a way to protect their core business. So, or if you're a startup company that's getting into AI search, you're starting from zero. If you can build a $10 billion business that's got 50% margins, that's incredible, and you'll make all your investors a ton of money. If Google goes from its current model to a $10 billion business, then everybody there gets fired. It's unfairly tilted in a way towards companies that aren't Google, because frankly, they have a lot less to lose.
So we've been playing around with generative AI, and the thing that strikes me is one, that Google offers you 5,500 results in 0.0003 seconds that are somewhere between 0 and 98% correct. And the thing I've noticed about generative AI is it says, here's one answer that we think is kind of 70 or 80% correct. And it comes down to this notion that, and we've always talked about this, that consumers don't want more choice. They want to be more confident in the choices presented. And I find it just easier and more comforting that I don't have to sort through all the crap, all the ad-supported stuff, or even potentially get to a better answer, but it gives me one answer and I can decide if I like it or not, or do another query. The other thing is it's a switch in business model. It's from ad-supported to subscription, which I think is just naturally healthier and focuses more on the end consumer as opposed to the advertiser. So 2 statements, and then I'll follow up with a question. What do you think Google should do? How should they respond? And do you think they are responding correctly? And do you think that it's going to be the Empire Strikes Back here, or is OpenAI and Microsoft, are they going to continue to quote unquote disrupt Google?
I think the primary thing Google has to do is diversify, right? They need to, which they're doing. I think they need to continue to expand their offering with things like Gmail and Docs and cloud services. Now, Gmail and Docs don't make them any money in the consumer space, but they continue to expand Google's footprint so that if the search, the 10 blue link and beyond era of search goes away, they've still got a lot of value to the customer and a lot of relationships with those customers. I think it would be a mistake for them to just throw the existing search structure out and go all in on Bard, because then they're just stepping into the battle with everybody else. Either their model of search is going to survive and AI chat is not going to take it out, in which case Google this isn't a disruptive innovation and Google just continues to own the castle, or their search business model is going to disappear. And if that's the case, they need new businesses and new revenue sources.
So, Jason, it's beginning to feel more and more that AI is becoming a commodity. I mean, Snap released its own AI chatbot. We have a Google AI chatbot, ChatGPT, OpenAI, Microsoft Bing. Apparently, Facebook is working on one as well. It's beginning to feel that these chatbots actually aren't that differentiated. And in a way, it feels like the point of differentiation between all of these companies is simply the user interface. And it's beginning to feel, to me at least, that the person who wins this, the company who wins this AI race is whichever company can nail the easiest, most seamless, most beautiful UI, and then just license out the chatbot to a ChatGPT or to an OpenAI, whoever's going to give them that large language model. Do you think that is a fair characterization of what's happening?
I think that I don't know that AI is a commodity exactly, but I think you're getting at something that makes it look a lot like a disruptive innovation, which is that it's cheap and cheerful, as Scott would say, because it's so scalable. So you have OpenAI has this underlying model, GPT, well, they have two, GPT 3.5 and GPT 4. And a lot of what you're talking about, like Snapchat, those are just ways to access that same underlying model. Now, there's a lot of competition for better models and better systems, and those will continue to evolve pretty quickly. But at the delivery of the product level, what you've got is something that's very inexpensive to deliver at scale and can be scaled very fast. It's just not as good. And that's the classic kind of situation that Christensen was talking about. So I think you're right in general that it could be the design and the interface. It could be any number of things that allows a company to develop those strong customer relationships and keep people coming to them to ask questions, right? It could also be the services you surround it with, right? So part of Microsoft's strategy is you're already using so many of our other products. And that's, in a sense, what Snapchat is doing, right? You're already here. Why don't you ask us some questions along the way? So there's a lot of ways to kind of sneak around Google's moats and deliver answers to people, information to people, using this very inexpensive to deliver AI technology.
Thanks, Jason. Scott, let's take a look at the week ahead. We'll be watching for the Fed's latest rate hike decision. We'll also see earnings from Apple, Shopify, CVS, Warner Brothers Discovery, AMC, Uber, and Lyft. Do you have any predictions for us?
Yeah, my prediction is around Tucker Carlson and Twitter. I think they're going to do something together. I think he's pissed off. And my impression of Twitter and Elon Musk is it's gone totally red pill. And they're going to come to
you
some sort of...
You accused me of being red pill yesterday, by the way. I just want to say that I'm still recovering.
What?
You accused me of being red pilled yesterday. I just want to say I'm still recovering from that.
Yeah, but I say it in an affectionate way. We need a conservative around here. We are so ridiculously woke around here. Other than my profanity, we are token Alan Alda meets a podcast. So you can be our token conservative.
Go ahead.
Or center right. Anyways, I think that Twitter's gone full red pill, and Musk is going to call, and Musk needs something. First it was like, okay, he's going to incorporate AI, or he's going to do payments. And it doesn't look like either of those have gotten any traction. Then it was blue check, and the whole blue check fiasco is see above a fiasco. So I wonder if he called Tucker and said, hey, Tucky, do you want 2% of Twitter or $400 million or whatever it is? And you can come be just totally crazy. And we'll start a video product, and you can do your show on Twitter. And it'll be a chance to stick up the middle finger to the Murdochs. And I have all of these. You'll get a ton of support on Twitter. Essentially, everyone I can tell with a blue check right now is either trying to sell me software or is totally red pill. But it feels like this is a platform in search of crazy. Because it's that type of polarization or polarizing content works on Twitter. And they now have less to lose because their revenues have gone from $5 billion to $2 billion. And I think a lot of the progressive advertisers or advertisers that might have had some reticence to advertise next to conservative polarizing content have already left. So it just feels like an arranged marriage that's going to turn out really well. So anyways, my prediction is Twitter and Tucker.
Any shot of him running for office?
I don't know if he's going to run, but I think he'll start polling in the double digits right away. I think that DeSantis will continue to fall. And I think a lot of people in the Republican Party are looking for a viable alternative to Trump, even if it's just for fun, because people don't like to settle on a winner this early in the process. So just some people who were leading at this point in the process or at this juncture in the electoral cycle from past GOP primaries. Herman Cain was the front runner at this point. whatever that was, 12 years ago. Rudy Giuliani. Remember, I don't know, you were probably 9 years old. Fred Thompson, the guy from LA Law, was actually the leading contender for the GOP nomination at some point. So you're going to see, I think, just some odd names pop up as number two. And I think that DeSantis's loss might be Tucker's gain, but I think he's going to pull into double digits regardless of whether he decides to run or not. Because if a failed casino owner and reality television star can be president, why the hell couldn't Tucker Carlson?
100%. And by the way, why couldn't you?
That's right. Go on. A chicken in every pot, a Cialis in every medicine cabinet. Galloway 2024. That's right.
All right, let's end it.
Have a wonderful rest of the week, Ed. You deserve it, you AI bitch.
So nice of you. Thank you.